This video is for educational purposes only and does not constitute investment advice. I lost $87,000 in 43 minutes because I thought I was smarter than the market. The date was March 15, 2019, and I was sitting in my cramped studio apartment in downtown Chicago, watching my entire trading account evaporate in real time. My hands were shaking so badly I could barely click the mouse to close my positions. But here's the thing that's going to blow your mind, and I need you to stay with me for the next 45 minutes, because what I'm about to reveal will fundamentally change how you approach every single trade for the rest of your life. That devastating loss wasn't actually the worst part. The worst part was realizing that I had been making the exact same mistake for 3 years straight. And it's the same mistake that 94% of retail traders make every single day. They enter too early. But what I discovered in the months that followed that catastrophic loss, what I'm about to share with you right now, is a complete systematic approach that has allowed me to turn that initial disaster into over $2 million in consistent profits. You see, most people think trading is about being right about direction. They think it's about predicting whether something goes up or down. But after losing everything and having to rebuild from scratch, after studying under mentors who manage hundreds of millions of dollars, after analyzing thousands of my own trades and the trades of consistently profitable traders, I discovered something that changed everything. Trading isn't about being right about direction. It's about being right about timing. And specifically, it's about having the discipline to wait for what I call the perfect storm setups. Right now, as you're watching this video, there are probably positions you want to enter. Maybe you've been eyeing a particular stock or crypto or forex pair for days. Maybe you're sitting there with your finger hovering over the buy button, feeling that familiar rush of FOMO, that fear that you're going to miss the move. I know that feeling because I lived in that feeling for years. But what if I told you that the very urge you're feeling right now, that need to get in before you miss out, is actually the #1 predictor of trading failure? Let me tell you about Sarah, one of my students who came to me last year after blowing up her third trading account. She was a brilliant software engineer, worked for Google, had an IQ that was probably twice mine, but she couldn't stop herself from entering trades too early. She would see a pattern forming, get excited, and jump in before the pattern actually completed. Sound familiar? She was making what I call the premature entry mistake, and it was costing her everything. But Sarah had one advantage that most traders don't have. She was willing to completely tear down everything she thought she knew about trading and rebuild from the ground up. And when she applied the system I'm about to share with you, when she learned to identify and wait for what I call the perfect storm conditions, she went from losing money consistently to making over $40,000 in her first 6 months. Now, before I dive into the specific methodology, I need to address the elephant in the room. You've probably watched dozens of trading videos, bought courses, read books, maybe even paid for expensive mentorships. You've probably heard about support and resistance, moving averages, RSI, MACD, all the standard technical indicators. But here's what nobody tells you, and this is crucial. All of that information is completely useless if you don't understand the one fundamental principle that separates consistently profitable traders from everyone else. The principle is this, and I want you to really let this sink in. The market rewards patience and punishes eagerness. Every single time you feel that urgent need to enter a trade, every single time you feel like you're going to miss out if you don't act right now, the market is essentially laying a trap for you. And the traders who make real money, the ones who compound their accounts year after year, they've learned to recognize these traps and avoid them completely. But avoiding the traps isn't enough. You also have to know what you're waiting for. And this is where most trading education completely fails you. They tell you to be patient, but they don't give you a specific, systematic approach to identify exactly when that patience should end and action should begin. They leave you sitting there wondering, okay, how long do I wait? What exactly am I looking for? How do I know when it's actually time to enter versus when I need to keep waiting? That's what I'm going to solve for you today. I'm going to give you a complete framework, a step-by-step system that tells you exactly what to look for and exactly when to act. But more importantly, I'm going to show you how to develop the psychological discipline to actually follow the system. Because let's be honest, knowing what to do and actually doing it are two completely different things. The system I developed, which I call the perfect storm method, is built around identifying the convergence of four specific factors. When all four factors align, the probability of a successful trade jumps from the typical 50-50 coin flip that most traders experience to over 85%. But here's the critical part. You have to wait for all four factors. Not 3 out of 4, not 2 out of 4, with a really strong feeling about the third, all four. And that level of discipline is what separates the professionals from the gamblers. Let me take you back to that devastating loss I mentioned at the beginning. March 15, 2019. I had been tracking a particular setup in the EUR-USD currency pair for about a week. I had identified a major resistance level that the price had tested 3 times over the past month. Each time, it bounced off that level and dropped significantly. I was convinced that the fourth test would result in another major drop, and I was right about the direction. But I was wrong about the timing, and in trading, being wrong about timing can be just as devastating as being wrong about direction. Here's exactly what happened. The price approached that resistance level for the 4th time, and I saw what I thought were early signs of rejection. The price had formed a small doji candlestick, which in technical analysis is often interpreted as indecision and potential reversal. I had seen this pattern work dozens of times before, so I entered a short position immediately, risking about 15% of my account on what I thought was a sure thing. But the price didn't reverse immediately like I expected. Instead, it continued to hover around that resistance level for another 6 hours. And this is where my lack of discipline really cost me. Instead of accepting that my timing was off and cutting my losses small, I convinced myself that I just needed to be patient. I told myself that the reversal was coming. It was just taking longer than expected. So I held on. Then, at 3:47 p.m. Eastern Time, the Federal Reserve released an unexpected statement that completely changed market sentiment. Within minutes, the EUR-USD broke through that resistance level like it was made of paper and shot up over 200 pips. My stop loss was blown through so fast that I couldn't even react. In less than an hour, I had lost more money than I had made in the previous 6 months combined. But here's what really haunts me about that trade. If I had waited for my complete perfect storm setup, if I had followed the system I'm about to teach you, I never would have entered that position in the first place. The fourth factor, which I call institutional confirmation, was completely missing. There were no signs that the big money, the institutional traders, were actually positioning for a reversal at that level. I was trading on hope and pattern recognition alone, which is essentially gambling with extra steps. That night, after I closed all my positions and accepted the devastating loss, I made a decision that changed the trajectory of my entire trading career. I decided to stop trying to be clever and start trying to be systematic. I decided to stop guessing and start waiting for certainty. And most importantly, I decided to study exactly how the most successful traders actually approach the market. What I discovered over the next 18 months of intensive research and testing completely revolutionized my understanding of trading. I spent thousands of hours analyzing the trades of consistently profitable hedge fund managers. I interviewed dozens of professional traders. I backtested countless strategies across multiple markets and time frames. And what emerged from all that research was a pattern, a consistent approach that all successful traders seemed to follow, whether they realized it or not. They all waited for what I now call the perfect storm conditions. They all looked for the same 4 factors to align before entering any significant position. And when those factors aligned, they acted decisively and with conviction. When those factors weren't present, they did absolutely nothing, no matter how compelling the setup might have looked on the surface. The first factor in the perfect storm method is what I call structural confluence. This means that multiple time frames are telling the same story. Most traders make the mistake of focusing on just one time frame, usually whatever chart they happen to be looking at. But professional traders always check at least 3 different time frames before making any decision. They look at the larger time frame to understand the overall trend and context. They look at their trading time frame to identify the specific entry opportunity. And they look at a smaller time frame to fine-tune their entry and manage risk. But structural confluence goes deeper than just checking multiple time frames. It means that the price action, the trend structure, and the key levels all support the same directional bias across all time frames. If the daily chart is bullish but the 4-hour chart is bearish, you don't have structural confluence. If the weekly trend is up, but you're looking for a short entry on the 15-minute chart, you don't have structural confluence. This might seem obvious, but you'd be amazed how many traders ignore this basic principle, and then wonder why their trades keep getting stopped out. Let me give you a specific example of what structural confluence looks like in practice. Last month, I identified a perfect storm setup in Apple stock that resulted in a 6-day winning streak and over $12,000 in profits. On the monthly chart, Apple was in a clear uptrend that had been in place for over 8 months. On the weekly chart, the stock had just broken above a significant resistance level and was showing strong momentum. On the daily chart, there was a clean pullback to the newly broken resistance level, which was now acting as support. And on the 4-hour chart, there was a clear reversal pattern forming right at that support level. All 4 timeframes were telling the exact same story. Apple was in a strong uptrend, had broken to new highs, was pulling back to test the breakout level, and was showing signs of resuming the uptrend. That's structural confluence. Every timeframe supported the same directional bias, and every timeframe provided confirmation that this was a high probability setup. But structural confluence alone isn't enough for a perfect storm setup. You also need the second factor, which I call momentum confirmation. This is where most traders get tripped up because they confuse price movement with actual momentum. Just because a stock or currency is moving in a particular direction doesn't mean it has genuine momentum behind it. Real momentum is about the quality of the move, not just the quantity. Momentum confirmation requires 3 specific elements. First, you need increasing volume or participation. In stocks, this means higher than average volume supporting the move. In Forex, this means multiple currency pairs showing similar patterns, indicating broad-based institutional participation. Second, you need what I call clean price action. This means the move is decisive and doesn't look like it's struggling or hesitating. Third, you need momentum to be accelerating, not decelerating. A move that's slowing down is often a sign that it's about to reverse. Here's where it gets really interesting. Most traders look for momentum after they've already decided they want to enter a trade. They're essentially looking for confirmation of what they already believe. But professional traders use momentum confirmation as a filter. They only consider trades where genuine momentum is already present. They don't try to predict where momentum will develop. They wait for momentum to reveal itself and then position accordingly. I learned this lesson the hard way through another significant loss. This one in Bitcoin back in late 2020. Bitcoin had been in a strong uptrend for months, and I was convinced it was going to continue. I had identified what I thought was a perfect buying opportunity during a pullback to a major support level. The structure looked perfect, the setup was textbook, but I ignored the fact that momentum was actually decreasing. The volume on the bounce was lower than the volume on the decline. The recovery looked weak and hesitant, rather than strong and decisive. I entered the trade anyway because I was so focused on the structural setup that I ignored the momentum signals. Bitcoin did bounce from that support level, but it was a weak, unconvincing bounce that lasted less than 2 days before it broke down and continued much lower. I lost $18,000 on that trade, money that I could have easily saved if I had simply waited for proper momentum confirmation. The third factor in the perfect storm method is what I call market context alignment. This is probably the most overlooked aspect of trading, and it's the reason why so many technically perfect setups fail. Market context is about understanding the broader environment in which your trade is taking place. It's about recognizing that no trade exists in isolation, and that the overall market sentiment, economic conditions, and institutional positioning all play a crucial role in determining whether your trade will be successful. Market context alignment means that the broader market environment supports your specific trade idea. If you're looking to buy a growth stock but the overall market is in a risk-off environment where investors are fleeing to safety, you don't have market context alignment. If you're looking to short a currency but that country just announced positive economic data, you don't have market context alignment. If you're trying to trade against the prevailing institutional positioning, you're swimming against a very strong current. Professional traders spend as much time analyzing market context as they do analyzing individual setups. They understand that a technically perfect setup in the wrong market environment is often a losing trade, while a mediocre setup in the right market environment can be incredibly profitable. This is why they're constantly monitoring economic calendars, institutional positioning reports, market sentiment indicators, and correlation patterns across different asset classes. Let me share an example that perfectly illustrates the power of market context alignment. In January of this year, I identified what looked like a perfect short setup in Tesla stock. The stock had been in a parabolic uptrend for weeks, it was severely overbought on multiple timeframes, and it was approaching a major resistance level where it had previously reversed. From a purely technical perspective, everything pointed to an imminent reversal. But when I analyzed the market context, I realized that the broader electric vehicle sector was experiencing unprecedented institutional buying. Major fund managers were rotating into clean energy stocks, and Tesla was the primary beneficiary of this rotation. The Federal Reserve had just signaled a more accommodative monetary policy, which was supportive of growth stocks like Tesla. And perhaps most importantly, retail sentiment was extremely bullish, which meant there was still plenty of buying power left to push the stock higher. Despite the technically perfect short setup, the market context was completely misaligned. I decided not to enter the trade, and it turned out to be one of the best decisions I made that month. Tesla continued to rally for another 3 weeks, gaining over 40% from where I would have shorted it. That technical resistance level that looked so significant was broken like it didn't even exist, simply because the broader market context was supporting higher prices. This brings us to the fourth and final factor in the perfect storm method: institutional confirmation. This is the factor that most retail traders completely ignore, and it's often the difference between a winning trade and a losing trade. Institutional confirmation means that the big money, the hedge funds, pension funds, and investment banks are positioned in alignment with your trade idea. You see, retail traders like to think that technical analysis and chart patterns are what move markets, but the reality is that institutions move markets. When a hedge fund decides to deploy $50 million into a particular stock, that creates real buying pressure that pushes prices higher. When a pension fund decides to reduce their exposure to a particular sector, that creates real selling pressure that pushes prices lower. And the most successful retail traders understand this and position themselves alongside institutional money rather than against it. But how do you identify institutional positioning when you don't have access to their internal reports and trading data? This is where most traders get frustrated and give up. But there are actually several ways to gauge institutional sentiment and positioning if you know what to look for. The key is understanding that institutions leave footprints in the market, and those footprints are visible if you know how to interpret them. Options flow is one of the most reliable indicators of institutional positioning. When institutions want to establish large positions, they often use options to leverage their capital and manage their risk. Unusual options activity, particularly in longer-dated contracts, can give you valuable insight into how the smart money is positioned. Dark pool activity is another indicator. When institutions want to buy or sell large quantities without moving the market, they often use dark pools. Sudden increases in dark pool volume can signal institutional accumulation or distribution. But perhaps the most important indicator of institutional positioning is what I call the footprint analysis. This involves looking at how prices react at key levels and what that reaction tells you about who's buying and who's selling. When a stock approaches a major resistance level and gets rejected with high volume, that usually indicates institutional selling. When a stock approaches a major support level and bounces with increasing volume, that usually indicates institutional buying. The key is learning to read these footprints and understand what they're telling you about the balance of power between buyers and sellers. And this is something that takes time and experience to develop. You can't just read about it in a book or watch a YouTube video and immediately become expert at it. It requires hundreds of hours of chart time and careful observation of how prices behave in different market conditions. I remember the first time I really understood the power of institutional confirmation. It was a trade in the S&P 500 futures back in September 2021. The market had been in a strong uptrend for months, but I was starting to see some concerning signs. Retail sentiment was extremely bullish, which is often a contrarian indicator. The VIX was at historically low levels, suggesting complacency. And most importantly, I was noticing that every rally was being met with increasing selling pressure at higher levels. The technical setup for a short trade wasn't quite there yet. The market was still making higher highs and higher lows. But the institutional footprints were telling a different story. I was seeing massive put buying in SPY options, particularly in longer-dated contracts. I was seeing dark pool activity suggesting institutional distribution. And I was seeing the market struggle more and more to maintain its upward momentum, despite positive news and strong economic data. When the market finally gave me a technical short setup 3 weeks later, I was ready. I had been watching the institutional positioning for weeks, and I knew that the big money was positioned for a decline. When the S&P 500 finally broke below a key support level with increasing volume, I entered a short position with complete confidence. Over the next 2 weeks, the market declined over 8%, and I made more money on that single trade than I had made in the previous 3 months combined. The beautiful thing about the perfect storm method is that it's not just about individual trade setups. It's about developing a complete systematic approach to the market that eliminates guesswork and emotional decision-making. When you have a clear framework for evaluating opportunities, when you know exactly what you're looking for and exactly when to act, trading becomes much less stressful and much more profitable. But implementing this system requires a fundamental shift in how you think about trading. You have to stop thinking like a gambler and start thinking like a business owner. You have to stop looking for the next hot tip or the secret indicator that's going to make you rich overnight. Instead, you have to commit to following a systematic process, even when that process requires you to pass on trades that look compelling on the surface. This is where most traders fail. They understand the logic of the perfect storm method. They can see why it works, but they can't bring themselves to actually follow it consistently. They see a setup that has 3 out of 4 factors, and they convince themselves that it's close enough. They get impatient waiting for the perfect alignment, and they start taking trades that don't meet their criteria. And slowly but surely, they drift back into the same patterns of impulsive, emotional trading that got them into trouble in the first place. The solution to this problem is what I call the accountability framework. This is a systematic approach to maintaining discipline and ensuring that you stick to your trading plan even when your emotions are pulling you in a different direction. The framework has 3 components: documentation, review, and adjustment. Documentation means keeping a detailed record of every trade you consider, not just the ones you actually take. For every potential setup, you document which of the 4 perfect storm factors are present and which are missing. You document your reasoning for entering or passing on the trade. And you document the outcome, regardless of whether you traded it or not. This creates the objective record that you can review and learn from. Review means regularly analyzing your trading performance and identifying patterns in your decision-making. Are you consistently entering trades that only have 3 out of 4 factors? Are you passing on trades that meet all your criteria because of fear or doubt? Are you making the same mistakes repeatedly without learning from them? The review process helps you identify these patterns and address them before they become ingrained habits. Adjustment means continuously refining your approach based on what you learn from your documentation and review. Maybe you discover that certain market environments require slight modifications to your criteria. Maybe you realize that your risk management needs to be adjusted for certain types of setups. The key is to make these adjustments systematically and deliberately, not impulsively based on a single good or bad trade. Let me tell you about Michael, another one of my students who struggled with consistency before implementing the accountability framework. Michael was a dentist from Phoenix, who had been trading for about 5 years with mixed results. He understood technical analysis, he had reasonable risk management, but he couldn't stop himself from taking trades that didn't meet his full criteria. He would see a setup that looked pretty good and convince himself to enter, usually with disappointing results. When Michael started using the accountability framework, something remarkable happened. Simply having to document his reasoning for every trade forced him to be more honest about whether setups actually met his criteria. The review process helped him see patterns in his decision-making that he hadn't noticed before. And the adjustment process allowed him to fine-tune his approach based on actual data, rather than emotions or gut feelings. Over the course of 6 months, Michael's win rate improved from about 55% to over 75%. More importantly, his average winning trade became significantly larger than his average losing trade, which is the key to long-term profitability. He stopped taking marginal setups and started waiting for true perfect storm conditions. And his trading account grew by over 60% during a period when the broader market was essentially flat. But the accountability framework is just one piece of the puzzle. You also need to develop what I call situational awareness. This is the ability to recognize when market conditions are favorable for your particular approach and when they're not. Not every market environment is suitable for every trading strategy, and the perfect storm method works best in certain types of conditions. The perfect storm method is most effective in trending markets with reasonable volatility. When markets are choppy and directionless, it becomes much harder to identify clear structural confluence. When markets are extremely volatile and driven by news events, technical analysis becomes less reliable. And when markets are in strong trending phases with very little pullback activity, there are fewer opportunities for the kind of setups that the method identifies. Understanding market phases and adapting your approach accordingly is crucial for long-term success. During trending phases, you want to be more aggressive about taking trades that align with the dominant trend. During consolidation phases, you want to be more selective and focus on range-bound strategies. During high volatility periods driven by news events, you might want to reduce your position size or step aside entirely until conditions normalize. This situational awareness develops over time as you gain experience with different market conditions. But you can accelerate the learning process by studying how prices behave in different environments and how successful traders adapt their strategies accordingly. The key is to remain flexible and objective, rather than trying to force your preferred approach to work in every market condition. I learned this lesson during the COVID-19 market crash in March 2020. The markets were experiencing unprecedented volatility, with daily swings of 5 to 10% becoming commonplace. My normal perfect storm setups were getting stopped out repeatedly because the market was moving too fast and too unpredictably for technical analysis to be reliable. I was trying to trade the same way I always traded, but the market environment had completely changed. It took me about 3 weeks to recognize that I needed to adapt my approach. Instead of looking for traditional trend-following setups, I started focusing on mean reversion trades around major support and resistance levels. Instead of holding positions for multiple days, I started taking profits much more quickly. And instead of using my normal position sizes, I reduced my risk per trade by about 50% to account for the increased volatility. These adaptations allowed me to not only survive the crash but actually profit from it. By recognizing that the market environment had changed and adjusting my approach accordingly, I was able to capture some of the biggest moves of my trading career. But it required putting aside my ego and admitting that my normal approach wasn't working in those conditions. This brings me to another crucial aspect of successful trading that most people overlook: the psychological component. All the technical analysis and systematic approaches in the world won't help you if you can't manage your emotions and maintain discipline under pressure. Trading is ultimately a psychological game, and the traders who succeed long-term are the ones who develop superior mental discipline and emotional control. The biggest psychological challenge in trading is learning to accept uncertainty and incomplete information. Every trade you take is essentially a bet on an uncertain outcome. You can do all the analysis in the world. You can wait for perfect setups. You can follow systematic approaches, but you can never know for certain what's going to happen next. And many traders struggle with this fundamental uncertainty. They want certainty where none exists. They want guarantees in a probabilistic environment. They want to be right all the time instead of being profitable over time. And this desire for certainty often leads them to make poor decisions, like holding losing trades too long because they can't accept being wrong, or cutting winning trades too short because they're afraid of giving back profits. The solution is developing what I call probabilistic thinking. This means accepting that trading is a game of probabilities, not certainties. It means understanding that your job is not to be right on every trade, but to identify situations where the odds are in your favor and then position accordingly. It means being comfortable with being wrong on individual trades, as long as you're following a systematic approach that gives you an edge over time. Probabilistic thinking also means understanding the concept of expected value. A trading strategy doesn't need to win every trade to be profitable. It just needs to win enough trades and win them by enough to overcome the losing trades. A strategy that wins 60% of the time with an average winner that's 50% larger than the average loser will be highly profitable over time, even though it loses 40% of its trades. But perhaps the most important psychological skill for traders is learning to separate your ego from your trading results. Many traders take losses personally, as if a losing trade is a reflection of their intelligence or worth as a person. They take winning trades as confirmation of their superiority and losing trades as evidence of their inadequacy. This emotional attachment to individual trade outcomes is one of the fastest ways to destroy a trading account. Professional traders understand that individual trade results are essentially random, even when they're following a systematic approach. They know that their edge comes from following their system consistently over many trades, not from being right on any particular trade. They celebrate their process, not their profits, and they learn from their mistakes without taking them personally. I struggled with this psychological aspect of trading for years. Every losing trade felt like a personal failure. Every winning trade felt like validation of my intelligence and skill. This emotional roller coaster was exhausting, and it led me to make poor decisions based on my emotional state rather than objective market analysis. The turning point came when I started thinking of my trading account like a business. I realized that every successful business experiences setbacks, unexpected expenses, and periods of reduced revenue. But successful business owners don't take these setbacks personally. They analyze what went wrong, make adjustments, and continue executing their business plan. They understand that short-term results don't determine long-term success. When I started applying this business mindset to my trading, everything changed. Losing trades became business expenses rather than personal failures. Winning trades became successful business transactions rather than ego boosts. And my focus shifted from trying to be right all the time to consistently following a process that I knew would be profitable over time. This shift in mindset also helped me develop better risk management habits. When you're treating trading like a business, you naturally become more careful about how much capital you risk on any individual opportunity. You start thinking about position sizing in terms of preserving capital and managing downside risk rather than maximizing potential profits. And you develop contingency plans for different scenarios rather than hoping that everything will work out perfectly. Risk management is probably the most important skill in trading, yet it's the one that most educational resources spend the least time on. Everyone wants to talk about entry strategies and technical indicators, but very few people want to discuss the boring but crucial topic of position sizing and risk control. This is backwards because risk management is what determines your long-term survival in the markets, while entry strategies only determine your short-term results. The foundation of good risk management is never risking more than you can afford to lose on any single trade. This sounds obvious, but you'd be amazed how many traders violate this basic principle. They convince themselves that a particular setup is so good, so certain, that they can afford to risk more than usual. They let their confidence in a trade override their risk management discipline. And when that sure thing doesn't work out, they suffer devastating losses that can take months or years to recover from. Professional traders typically risk between 1% and 3% of their account on any single trade. This might sound conservative, but it allows them to survive long losing streaks without suffering permanent damage to their capital. It also allows them to stay psychologically stable during difficult periods, because no single trade can significantly impact their overall financial situation. But proper risk management goes beyond just position sizing. It also involves having clear rules for when to exit losing trades and when to take profits on winning trades. Many traders spend all their time focusing on when to enter trades, but give very little thought to when and how to exit them. This is like spending hours planning a road trip, but not bothering to figure out where you're going to stop for gas. Stop losses are essential for controlling risk, but they need to be set based on technical levels rather than dollar amounts. If you set your stop loss based on how much you're willing to lose, you're essentially letting your risk tolerance determine your trade structure, which is backwards. Instead, you should identify the technical level that would invalidate your trade thesis, set your stop loss there, and then calculate your position size based on that distance. Similarly, profit targets should be based on technical analysis rather than arbitrary profit goals. The market doesn't care how much money you want to make on a trade. It's going to do what it's going to do based on supply and demand dynamics. Your job is to identify realistic price objectives based on chart patterns, support and resistance levels, and market structure, and then position accordingly. One of the most advanced risk management techniques is what I call dynamic position sizing. This involves adjusting your position size based on the quality and confidence level of each setup. When you have a perfect storm setup with all four factors clearly present, you might risk the maximum amount allowed by your risk management rules. When you have a setup that's good but not perfect, you might risk a smaller amount. This allows you to be more aggressive when conditions are optimal and more conservative when conditions are less certain. Let me share a specific example of how dynamic position sizing worked in practice. Last month, I identified two potential trades on the same day. The first was a perfect storm setup in Microsoft with clear structural confluence, strong momentum confirmation, supportive market context, and obvious institutional buying. The second was a decent setup in Amazon that had good structure and momentum, but questionable market context and mixed institutional signals. Instead of risking the same amount on both trades, I risked 2% of my account on the Microsoft trade and only 0.5% on the Amazon trade. Microsoft ended up being a big winner that made over $4,000, while Amazon was stopped out for a small loss. If I had risked the same amount on both trades, the overall result would have been much less favorable. This kind of sophisticated risk management comes from experience and deep understanding of what makes some setups better than others. But it starts with the basic discipline of never risking more than you can afford to lose, and always having a clear plan for managing both winning and losing trades. As we start to wrap up this deep dive into the perfect storm method, I want to address one of the most common questions I get from traders. How long does it take to become consistently profitable? The honest answer is that it depends on several factors, including your starting capital, your learning curve, your ability to maintain discipline, and your commitment to following a systematic approach. Most traders underestimate the time and effort required to develop real skill in the markets. They think that because trading looks simple on the surface, it should be easy to master quickly. But trading is like any other professional skill. It requires years of dedicated practice, continuous learning, and constant refinement. The traders who succeed long-term are the ones who approach it like a serious profession, rather than a get-rich-quick scheme. Based on my experience working with hundreds of students, most people need at least 2 to 3 years of consistent practice before they develop the skills and discipline necessary for consistent profitability. This doesn't mean they can't have winning trades before then, but it typically takes that long to develop the psychological discipline, risk management skills, and market understanding necessary to be profitable over all market conditions. The key is to focus on the process rather than the profits during this learning phase. Instead of measuring your success by how much money you make each month, measure it by how well you follow your trading plan. Instead of trying to maximize your returns, focus on minimizing your mistakes. Instead of taking big risks to accelerate your progress, focus on building good habits that will serve you for years to come. This learning phase is also when you should be doing most of your experimentation and refinement. Every trader needs to adapt general principles to their own personality, schedule, and risk tolerance. The perfect storm method provides a framework, but you need to customize it to your specific situation. Maybe you need to focus more on certain markets or time frames. Maybe you need to adjust your risk management based on your capital size. Maybe you need to modify your entry or exit criteria based on your psychological tendencies. The important thing is to make these adjustments systematically and deliberately, not impulsively based on a few good or bad trades. Keep detailed records of your experiments and their results. Test modifications thoroughly before implementing them permanently. And always maintain the core principles of waiting for high-probability setups and managing risk carefully. I also want to emphasize the importance of continuous education and staying current with market developments. The markets are constantly evolving, and what worked 5 years ago might not work today. New technologies, changing regulations, evolving institutional strategies, and shifting global economic conditions all impact how markets behave. Successful traders never stop learning and adapting. This doesn't mean chasing every new trading strategy or indicator that comes along. It means staying informed about major market developments, understanding how different economic factors impact your trading, and continuously refining your approach based on changing market conditions. It means reading relevant books, following respected market analysts, and maintaining connections with other serious traders. But perhaps most importantly, it means maintaining a humble attitude toward the markets. The moment you think you have the markets figured out, the moment you become overconfident in your abilities, the markets will humble you. The most successful traders I know, people who have been profitable for decades, still approach each trade with respect for the uncertainty and risk involved. They understand that past performance doesn't guarantee future results. They know that market conditions can change rapidly and unexpectedly. They respect the fact that there are many other smart, well-funded participants trying to profit from the same opportunities they are. and they never risk more than they can afford to lose, no matter how confident they feel about a particular trade. This humble, respectful attitude toward the markets isn't just about risk management. It's also about maintaining the psychological flexibility necessary to adapt when conditions change. Overconfident traders become rigid and stubborn. They try to force their preferred strategies to work even when market conditions have shifted. They ignore warning signs because they contradict their preconceived notions about how the market should behave. Humble traders, on the other hand, remain flexible and adaptive. They're willing to admit when they're wrong and adjust their approach accordingly. They pay attention to what the market is actually doing, rather than what they think it should be doing. And they're constantly looking for ways to improve their process and refine their edge. As I look back on my trading journey, from that devastating loss in March 2019 to where I am today, the biggest lesson I've learned is the power of systematic thinking and disciplined execution. The perfect storm method isn't just a trading strategy. It's a framework for making better decisions under uncertainty. It's a way of thinking that can be applied to any situation where you need to evaluate opportunities and manage risk. The 4 factors: structural confluence, momentum confirmation, market context alignment, and institutional confirmation, force you to consider multiple perspectives before making any decision. They prevent you from getting tunnel vision or falling in love with a particular idea. They ensure that you're not just seeing what you want to see, but actually analyzing what's really happening. But the real power of the method comes from having the discipline to wait for all 4 factors to align. This is where most people struggle, because it requires patience in a world that rewards action. It requires saying no to opportunities that look good but aren't great. It requires accepting that sometimes the best thing to do is nothing at all. This patience and selectivity is what separates professional traders from everyone else. Amateurs feel like they need to be constantly active, constantly finding new trades, constantly making money. Professionals understand that the money is made by waiting for the right opportunities and then acting decisively when those opportunities present themselves. Think about the most successful investors and traders throughout history. Warren Buffett doesn't make hundreds of investments every year. He waits for exceptional companies at reasonable prices and then makes large, concentrated bets. George Soros didn't make trades every day. He waited for major market dislocations and then leveraged his conviction with massive positions. Paul Tudor Jones doesn't chase every market movement. He waits for high-probability setups and then manages his risk carefully. What all these legendary investors have in common is patience, selectivity, and the discipline to follow their systematic approach even when it's difficult or boring. They understand that in investing and trading, it's not about how often you're right or how many trades you make. It's about the magnitude of your wins versus your losses, and your ability to position size appropriately based on the quality of each opportunity. The perfect storm method gives you a framework for making these same kinds of systematic, disciplined decisions. It helps you identify truly exceptional opportunities and ignore everything else. It prevents you from overtrading, chasing marginal setups, or letting emotions drive your decision-making. And it gives you the confidence to act decisively when the right opportunities do present themselves. But remember, no method or system is perfect. Markets are complex, dynamic systems with countless variables that can't all be predicted or controlled. Even with the perfect storm method, you will still have losing trades. You will still experience periods of drawdown and frustration. You will still need to continuously adapt and refine your approach as market conditions change. The goal isn't to eliminate losses or achieve perfect accuracy. The goal is to consistently identify situations where the odds are in your favor and then position accordingly. It's to develop the psychological discipline necessary to stick with your system even when it's difficult. It's to build a sustainable approach that can generate consistent returns over years and decades, not just months. This is what real trading success looks like. It's not about making a fortune overnight or finding the secret formula that guarantees profits. It's about developing professional-level skills, maintaining strict discipline, and continuously improving your approach over time. It's about treating trading like the serious business that it is, with all the responsibilities and commitments that entails. If you're ready to make that commitment, if you're ready to stop gambling and start trading systematically, then the perfect storm method can be the foundation of your success. But it will require patience, discipline, and a willingness to do things differently than most other traders. It will require you to pass on trades that look appealing but don't meet your criteria. It will require you to wait for true high-probability setups even when it's boring or frustrating. Most importantly, it will require you to shift your focus from trying to make money to trying to trade well. When you focus on following your process and making good decisions, the money follows naturally. When you focus on the money first, you make poor decisions that ultimately cost you more than you could ever make. So here's my challenge to you. For the next 30 days, commit to implementing the perfect storm method exactly as I've described it. Document every potential trade you consider, noting which of the 4 factors are present and which are missing. Only enter trades where all 4 factors are clearly aligned. Use proper risk management and position sizing on every trade. Keep detailed records of your results and review them regularly. I guarantee that if you follow this approach consistently for 30 days, you'll see a dramatic improvement in your trading results. Not because the method is magic or perfect, but because it will force you to be more selective, more disciplined, and more systematic in your approach. It will break you out of the pattern of impulsive, emotional trading that destroys most retail accounts. After 30 days, if you've truly followed the system consistently, you'll have a clear understanding of what high-probability trading looks like. You'll have developed better habits around patience and selectivity. You'll have improved your risk management and position sizing. And you'll have gained confidence in your ability to identify and execute quality trades. But this is just the beginning. Real trading mastery takes years to develop, and it requires continuous learning and refinement. The perfect storm method is a foundation, not a destination. As you gain experience and develop your skills, you'll find ways to enhance and customize the approach to better fit your personality and circumstances. The key is to never stop learning, never stop improving, and never lose respect for the difficulty and complexity of what you're trying to accomplish. Trading is one of the most challenging professions in the world, but it's also one of the most rewarding for those who develop the skills and discipline necessary to succeed. I hope this deep dive into the perfect storm method has given you valuable insights into what it really takes to be successful in the markets. More importantly, I hope it's inspired you to approach trading with the seriousness, discipline, and systematic thinking that it demands. The markets will always be there, but your capital and your opportunity to build long-term wealth are finite resources that must be protected and deployed wisely. If this video has helped you understand something new about trading, or if you're committed to implementing the perfect storm method in your own trading, I'd love to hear about it in the comments below. Share your thoughts, your questions, and your experiences as you work to improve your trading results. And if you found this content valuable, please hit that like button and subscribe to the channel for more in-depth trading education and market analysis. Your support helps me continue creating content that can genuinely help traders improve their results and achieve their financial goals.